Hey there, folks. I just want to quickly jump in here and let you know that I'm on the other side of the world. I've just watched this amazing sunrise up here over the range here in Africa, but I couldn't let this moment go without just reminding my mate that I think Freo might have won this week. So I'm just sitting here with some friends watching the sunset, and we've got a message for you, Ben. Go Freo! Mate, looks like your team is starting to falter at the very finish line. Go Freo. Let's get on with the show.
All right, folks, welcome back to the Property Couch podcast, and we've got an amazing show for you today. We're going to show you what does Fight Club and land tax have in common, Ben. That's very, very interesting to find out. And we're also going to tell you why land tax is potentially the biggest surprise in property. What else do we cover, Ben?
Well, Bryce, you've got me already interested, but we're also going to wonder about how do you dispute a land value in your land tax? And finally, in what's making property news, Bryce, how do I buy, or can I buy, a $500,000 property in one of our major capital cities or in all of our major capital cities? I'll unpack that in what's making property news.
Can you buy under 500,000, Ben? You got to stick around for that, folks. Let's rip into the show.
Welcome to the Property Couch, where each week you get to listen to two of Australia's leading experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel, co-host of Escape from the City on the ABC, and partner of Empower Wealth Advisory. Ben Kingsley, chair of Property Investors Council of Australia and the founder of Empower Wealth Advisory, named the 2018 and 2019 Property Advisory Firm of the Year. Stay tuned as they bring you the insider's guide to property, finance and money management.
All right, folks, welcome back to the Property Couch podcast, and of course, welcome back to you too, mate. How are you?
Mate, remember this day.
All right.
Remember this day. It's an exciting day. I'm always
24th of
excited
July.
about certain things, but always remember this day because it's the first day you and I will be telling our community about another major Moorr release, Bryce. Another major Moorr release.
Mate, I was wondering where that was going, but
Did you know that we have over 19,000 property investment users of the Moorr platform?
Wow.
And they are tracking over 34,000 investment properties on our platform. But Bryce, today, you and I get to introduce the first release of the brand new MyPROPERTY dashboard.
Oh, tell me more, Ben.
Well, it allows you to analyze single or multiple properties in your portfolio. So you can do them standalone. You can select groupings and put them together. You can do any type of combination, total aggregate assessments of your portfolio. So, and it's just really powerful, right? Because off the back of that, you're going to be able to analyze your properties assets like you had never done before. So things like tracking your portfolio wealth position over time. In terms of portfolio cash flow projections, you can also use the with or without offset benefit, which is a unique feature. I don't think I've seen any of that on any other tool out in the marketplace doing that. The loan breakdowns. A lot of people get a little bit confused when they've got a few properties in terms of properties security versus purpose. You've got a toggle switch that will show you what different loans are connected to which particular property assets. Plus, you also then show the offset links, part of the card feature inside the platform. And of course, we've got all of the staples, Bryce. LVRs, equity positions, repayment details, all the basics are also included under the new MyPROPERTY section inside Moorr.
Mate, that is exciting. That is
big.
That's what people want, Ben. They want to be able to go in there and actually be analysing their portfolio. So that is a significant leap forward, Ben. I felt like I was going to go one giant step there.
But do yourself a favour, as Molly Meldrum would say. Do yourself a favour. Yeah. Check it out. And Bryce, free. We can't encourage anymore. And that's on the web application. So you can still sign up on mobile, get some of your data in there, but this is a feature that's available in the web app. It'll eventually be available also in mobile time as well.
On the continued mission to make more better, moorr.com.au. Go and check that out, folks. And hey, we've got a very special guest today, Ben. So we want to get into that conversation very quickly. But My mindset minute squeeze. My mindset minute today is about the midlife squeeze, right?
Yes.
So your 40s, you know, they're supposed to be your prime, but for many, they're actually the hardest decade of all because Ray Dalio, who we talked about a couple of weeks ago, he calls it the midlife squeeze. It breaks more people than we realise because you get stretched thin. You know, kids need money, parents need care, work is relentless, and the pressure to build wealth before retirement's at an all-time high. So, and if you look into the data, that backs it up too, because across many countries, life satisfaction hits rock bottom in your late 40s. Sobering, right? Particularly if you're listening to this and you're in your mid-40s, you're thinking, geez, what's coming? But and because you're stuck in this squeeze generation of supporting aging parents whilst raising kids, juggling the debt, you know, the responsibilities and expectations. So the relief just feels relentless, right? So, but here's the truth: it isn't something that you just take it as a given, right? It's not your forever; it's just a window. Like it's time to stop surviving and, you know, get designing. So, the truth is, this window that you're in really matters because it's the last great runway to build wealth before retirement. So, I think we should make it count. So, given I just ticked over 50, Ben, talked to a lot of people in this age bracket. You know, it's. I guess that's probably why we wrote the book, Ben, because, you know, whilst you are in this major sort of energy zap zone of your life cycle, we kind of wrote it so it was really easy to digest in this busy season of your life. So it applies if you're 20s, applies if you're 30s, but I just really wanted to speak to the 40s window today, Ben. Those people who might be, you know, experiencing what Ray Dalio.
There's a lot of people, Bryce, whose parents now, the baby boomers, have had some, you know, at least a decade or more of super. So hopefully they're not in that difficult situation where their parents are still on struggle street. So if that is the case, then you're the perfect candidate to start focusing on getting some wealth building assets. And that's really, you know, our target audience for this book has always been those 30 to 50-year-old cohort, families with a little bit of equity. Start putting that away and start looking towards your, you know, building it, because it's the time story here that matters. The longer you can hold on to those assets, the better you'll be. So
the message here is it's your window, folks. It's the window that you can actually have a really nice runway still through to retirement. So don't submit to the midlife squeeze is probably the message here, Ben. There's still time. There's still opportunity for you to make sure that you do something so you've got a meaningful retirement. Hey, we've got a really special guest today. He's talking to us about a topic that is potentially one of the biggest surprises for a lot of property investors. So let's cut to the interview you and I recently had with Vish Sharma. All right, Ben, we've got a very special guest today on the Property Couch. We are talking with Vish Sharma, who's a senior advisor at Revenue New South Wales, where he specialises in land tax. With over 20 years of experience across all levels of government and more than a decade at Revenue New South Wales, Vish brings deep expertise across the full spectrum of taxes and grants administered by the department. Revenue New South Wales plays a critical role in managing taxes, fines, debts, and grant programs, helping to fund the future of New South Wales and give back to the community. Welcome to the Property Couch, Vish.
Thanks for having me, guys. Nice to see you.
All right. It's a pleasure. We're looking forward to the chat today because we're talking about a topic that is land tax. And of course, you're going to be very specific towards New South Wales, but we want to tell all of our audience that a lot of what we're talking about today is actually universal. It's global across this great country of ours. So whilst we will go into some nuances around New South Wales, we want everyone to stick around because there's a bit we're going to cover. But my opening question for you, Vish, is this. Land tax often catches investors by surprise. Why do you think that is? And what's the most important thing they need to know up front?
Well, look, I think there's a couple of things there. Firstly, it catches people off guard all the time. And it's one of the biggest pieces of feedback that we get from our land tax customers here in Revenue New South Wales is that, oh, no one told me about land tax. You know, my accountant didn't tell me, my conveyancer didn't tell me, like, no one told me. So they go through the entire property journey or the acquisition journey from, speaking to a real estate agent or a buyer's agent. They'll then do the purchase, they'll have a solicitor or a conveyancer, they'll own the property for a while, they might have a property manager, and then they'll even lodge a tax return or two before we go, hey, buddy, like, you should have registered for land tax. And they're like, but no one told me. So I sort of think land tax is it's like Fight Club amongst the property industry professionals out there. It's just, you don't talk about it. I think that comes down to two main things. One, it's, for some people, I think it's a bit of a turnoff from investing. So I think there are some industry professionals who just go, you know what, land tax, you worry about that later. It's tax deductible, whatever. There's that sort of mentality. But I think the other side of it as well is, as you mentioned, it is different across different jurisdictions. So, it operates a little bit differently in New South Wales, a little bit differently in Victoria and Queensland. And so, amongst all the states, it's hard to be an expert and really know about the ins and outs of land tax across all those jurisdictions. So, but I think that's the main reason why it's just not well known, because it's hard to find an expert to talk about it. And it's not necessarily the first thing that comes to mind when you're talking property investment or ownership.
And that is why we're having this chat.
Well, we're having the
We're
chat.
looking forward to unpacking that.
Hey, Ben, Fight Club and land tax. Did you ever think those two were going to be grouped together?
No, that's right.
Wow.
Fight Club. It's not. Don't talk about Fight Club. Don't talk about. I like that. Let's Vishal. Let's learn a little bit more about you and your personal money backstory. So tell us about how you grew up and how does money work in your household and how you think about money, because ultimately at the end of the day, the people that we're talking to today are looking at investing in property because they want to build wealth to provide for themselves and their family. So tell us a bit about your money backstory.
So look, I guess my money backstory is, it's not extravagant or anything. I mean, I was my family migrated to Australia when I was just very young, 2-3 years old. From Fiji, we didn't come with a lot. So I think, when we were young, money was just, it definitely wasn't in abundance. So we learned at a young age to have a lot of respect and value for money. And I think that's kind of stuck with us growing up in my household. We've all sort of had it drilled into us. Like I guess a lot of migrant children would probably be able to relate to, you've got to get a good job and you've got to, earn some money. And, my parents were blue collar workers and they're like, you don't want to be working 5 days a week plus overtime on the weekends just to get by like we are. So I think, early on in life, I got a good appreciation for the value of money. And, I sort of grew up watching my parents go through a lot of hard work, a lot of hours, and then eventually, owning their own home and looking to purchase a couple of investment properties of their own, later down the track. So, sort of had a good example from my parents in the way that they've tackled money. And I think I've learnt probably not as much as I should, but I've learnt some good things from them along the way.
Yeah, tell us a little bit about that migrant attitude, right? Because, quite often money's been a taboo, which is the reason that Ben and I ask this question of everyone, just so that we can remind everyone to have the conversations. But migrant families and that migrant attitude is different, right? Because it's quite often we're all in this together. We've all come to a new place. We've all got to try and make this work. And so you obviously said that your parents are hard workers, which is often the case to get ahead. But did I hear you just said then, did they end up buying investment properties down the track, or were they encouraging you to buy investment properties down the track?
So they did buy a couple, as they sort of got into they would have been in their 50s, I think, when they purchased their first investment unit, an apartment which they still own. But, essentially, like, as I said, it's... to give you an example, like when we first moved to Australia, and I was very young, so I don't remember it that well. I have some very vague memories of the house that we first rented when we moved here, and in our language, in our mother tongue, like the translation for what we refer to that house as to this day is the broken house. Like that's right. So I think when you grow up in that kind of setting and you sort of see how hard work and determination can get you to a place where you've got a home that's paid off, you've got a couple of investment units and some passive income coming your way. It's something that, me and my sisters now strive to achieve for ourselves as well.
And Vish, do you remember what you did with your first job and the first pay packet you got? Like, do you see yourself as someone who's a saver or a spender more generally?
I think it's changed a bit as I've gotten older. I think I was more of a saver, and now these days my wife keeps me in check. But no, look, I think I was a good saver, and my father in particular would encourage me when I was young. Doing things like buying your first car, or getting into the property market. It was very much around, you don't need a flashy car, you just need a car that's going to be reliable and get you to A to B. Spend it wisely. And he would do this thing where he would say, save a little bit. So if you save $5,000, I'll give you an additional $5,000, and then you can go use that to buy a good, reliable car. But if you're going to go buy something stupid, I'm not going to give you that money. So that would always
safe and reliable. Yeah, just safe, reliable, not flashy.
That's
just
right.
Safe and reliable. Yeah, got it.
So, Vish, it sounds like your dad, and maybe your mum, we just haven't mentioned a story, but it sounds like there was a lot of mentoring there. It sounds like there was a lot of conversations that were being seeded into you. You mentioned your sisters. Is there 1, 2, 3? How many sisters?
I've got 2 older sisters.
Yeah, so you're the baby in the house, right?
So I am, yes.
So Dad would pull you aside and have these chats, or was it just by the by?
No, it was just open conversations. Dinner table conversations even. And he supported all the children equally in the same kind of way, but always incentivized, making wise money choices as we grew up, and that's kind of stuck.
And Vishal, I like to ask this question, growing up in the same household, with your sisters, without giving too much away, are they similar? Are they spenders, savers, or does everyone have their different money behaviours?
I think we're all pretty well balanced with the spending, saving.
Okay.
They're doing quite well. And they work quite hard.
Excellent.
To support their family. So yeah,
beautiful.
So Vish, you've been in the government system for 20 years. So you've built up a real pedigree, and clearly you're operating at a level now to try and go, surprise, land tax is here. That's largely your role now, is to inform people. But how did you get there, mate? Tell us a little bit about the pathway for you getting into your first job, and how did it actually lead to where you are now?
Yeah, so look, I mean, I've done a few different jobs along the way, so I'll just focus on my time here at Revenue more so. But, I came in entry-level role working in our tax debt area, so heavily focused on collections of overdue debt. And I mostly started in land tax, so collecting land tax overdue liabilities. And as a collections officer, you don't necessarily need to know everything about the product in terms of how it's assessed and calculated, but just a genuine interest in it, and good trainers, good mentors here at work that taught me everything I knew about land tax. And, as different roles and opportunities sort of came up, I moved out of the collections area into our land tax assessing area, and then moved into some leadership roles. And I've worked across our operations, compliance, grants and relief, and even worked across different products like payroll tax and first-time buyers as well along the way. But these days my focus is on land tax engagement, and that's what me and my team work on for the most part, doing awareness and education about land tax.
What have you found is the most effective way for you to say, look, we're here, this is, obviously coming on platforms like ours to spread the message, but outside of, say, the podcast format, what's been the most effective way for you to raise awareness?
But look, we do a few things. As I sort of spoke about before, we've got a lot of industry professionals who shy away from the topic. So we've had a strong focus on doing education and awareness amongst industry professionals. So that's through some of your key industry bodies, and really promoting, land tax, what it is, how it works, considerations that people don't often think about when they're giving financial advice around. It is calculated differently for different types of ownership structures in some cases, and just trying to get the message out there. So a lot of focus on industry to start off with, but in recent times we've started doing a little bit more like community events, things like these webinars and podcasts to try and spread the message a little bit wider and try to connect directly with home buyers and investors around everything that Revenue New South Wales has a footprint on in the property industry.
All right, so let's rip into it then. Okay, let's pull the Band-Aid off and let's talk about land tax. What is land tax, Vish?
All right, so look, this is pretty similar for most states, but I'll focus mostly on New South Wales. So it's a tax on the land value of the property that you own. And it's not calculated a property at a time. It's calculated on your portfolio. So I, as an entity, might have an ownership interest in 10 properties. All 10 of those are going to contribute to my land tax bill. So it's calculated based on the unimproved land value, which is similar to what you see on your council rates. Big difference. Council rates, you'll see your value change every 3 years. Land tax, you'll see it change every year. So there's an annual valuation that's done by the Valuer General of New South Wales. Unimproved land value, meaning it's just the value of the land, not any buildings or improvements on it. And then, essentially, so what we do is we take those values annually. We work out the 3-year average for the last 3 years on a particular property. And then we add up all of your property portfolio and we say, all right, this is how much land tax you're going to pay. It sounds simple when you put it like that, but there's a lot more that kicks in. Like I said, some entity types have different threshold entitlements and things like that. And then the other thing that makes it a little bit more complicated is when you have multiple ownerships going on. So for argument's sake, Ben, if you and I owned a couple of properties together, we would have a land tax account together, assuming that we cross the threshold. And then I might have a couple of properties that I own with Bryce and I might be paying land tax there. And I could do that with so many people and receive multiple land tax thresholds. So what ends up happening there is there's a bit of a wash that happens. We call it primary and secondary ownership. So then I'll also be looked at as an individual to make sure that all my ownership interests are considered and that I only get the benefit of one threshold. So I might end up having to pay a little bit more if I've got lots of joint ownerships happening.
Oh, there's a bit in that.
There is a bit in that.
We'll unpack thresholds and all that in a second. A couple of things I just want to touch on. Obviously, if you and I were in ownership and I had 10% and you had 90%, that comes into consideration in terms of the proportion of tax that I pay, correct?
Correct. So how that works is, so jointly, when we own a property jointly, we're joint and severally liable to pay the tax. Any joint ownership that you have will receive the benefit of this threshold that I was talking about. There is a tax-free component to our threshold for land values up to about 1,075,000 is what it is at the moment. So essentially, once you cross that, you are paying land tax. Now, for argument's sake, Ben, just if I was a 90% owner and you were a 10% owner, that's fine. Now, let's just say we only own one property together. The value of that doesn't quite reach the threshold. The reason that we do these whole primary, secondary, assessments is I could duplicate that type of ownership structure 10 times with 10 different people, right? And get a tax-free threshold every single time. And the reason that it's done that way is not to disadvantage the other person that's purchasing with me or the other entity, right? So they're still entitled to thresholds too. And so that's why we do that primary, secondary thing. It's to make sure. So when that secondary part kicks in, yes, they're considering me for 90%.
So, but the joint and several liability point that you just raised, that's basically saying that if you don't pay your portion, I'm still potentially liable because I've got interest in that property, and I'm
just for
liable,
the property that we own together.
Yeah, but I'm liable for 100% of that. So the proportionality of ownership is not necessarily considered when the government's potentially collecting that revenue.
Yeah, when it comes to collections time, any joint owners can be held, jointly and severally liable to pay land tax, regardless of ownership percentage.
Okay.
It's more at that secondary level where the ownership percentage really kicks in to make sure that the tax is being calculated equitably for everyone.
No, it's a good reminder for people about joint several liability around going into partnerships into property, in the sense that, what I said initially was, surely I'm only reliable for my portion of ownership, but that's not necessarily the case. So it is a reminder to people when they are thinking about going into agreements to buy property assets together. And I think, there's the first takeaway from, why these episodes are so important, because we're learning so much. Can we talk to now let's talk to the rates and the thresholds?
Before we go there, Ben, just
Bryce,
a couple of clarifying points too for you, Vish. One, land value according to who, right? Unimproved land value, right? So according to who? And you talked about the 3-year average. So what happens if you've had New South Wales has peaked on year 1, and we're about to go year 4, and will the rates come down when it takes out a spike? Or did the tax rates never come down?
So, okay, 2 things there. So we'll answer both. So firstly, with the rates, right, and the 3-year averaging, we provide a 3-year average. The reason is to take out the spikes. That's the whole point of it, right? So where you have scenarios where there might be rezoning, or if one particular area is just having substantial growth, it just smoothens that out. So when you get your land tax bill, you don't get a massive surprise. Like, hey, congratulations, your property value's gone up heaps. Here's your bill. So yeah, it's the 3-year averaging is for that purpose, to clear out those spikes. If there is, and it works both ways. Averaging works if the prices are going down or up. But yeah, that's how the averaging works.
And according to who? The land value.
In the land value. So the land value is done by the Valuer General of New South Wales. Right, so they're the main valuing authority in New South Wales. The way that, they're their own entity. We don't really get involved with the valuation process all that much. However, what they do is they have a mass valuation process that they follow. So they've got their own legislation and their own criteria of how they go out and value land. Generally, they'll get a certain area and they'll go, okay, there's X number of like properties in a particular area, and then they'll take that mass valuation approach. And then they'll, they do bring in the characteristics of different parcels of land. But I think at its core, the important thing to remember is that those valuations are still based on market values to an extent. So while they don't consider any buildings or improvements on the land, if the market is moving in a certain direction in an area that they're valuing, that will reflect in the land values as well.
Now, I can just imagine everyone wants to know, can I dispute that and so forth. I'm going to leave that for maybe later on. Let's keep moving through, because it might sort of come out in the wash in terms of what we're talking about right now. So let's go through those 2025 rates and thresholds. So from 0 to 1.075, so $1,075,000 is tax free. What's the next level?
All right. So from 1,075,000 up to a little shy of 6.5 million, it's 1.6% of the taxable value of your portfolio. So 1.6% plus $100. So that's what the rate is. You only pay on the portion that exceeds the 1,075,000. So if I had $1.1 million worth of land value, I'm not paying on 1.1 billion. I'm paying on $25,000 worth of land value. Right. So that's how that works. Once you reach that premium threshold, as I said, it's a little shy of 6.5 billion. But once you exceed that premium threshold, the rate goes up to 2% for every dollar of land value that exceeds that.
Gotcha.
So that's 6.57 million. Is that right? Have we got that or is it 6.47 million?
It's 6.471, I think, something like that. Right. So it's a little, as I said, a little shy of 6.5 mil.
Okay, and then over that 6.47 odd million, what's the final figure there?
Yeah, so as I said, from there it becomes 2%. So
and again, 2%, it's 2% of that land value.
Land value that exceeds.
Yep.
Now there's for foreign persons, Vish, there's land tax to pay plus a surcharge. Can you talk us about what the
Correct.
surcharge is and why there's a surcharge on top of the land tax?
All right. So the surcharge it's a surcharge for foreign owners only. Okay. So to clarify, if you're an Australian citizen, regardless of whether you're living in Australia or living elsewhere, you're not considered a foreign person. If you're not a permanent resident, you are a foreign person. Okay. Where it gets a little bit trickier is if you are a permanent resident, okay, then there's some rules that apply every single year to determine whether or not you're considered foreign for surcharge land tax. So surcharge land tax it's quite different to land tax. The similarity is based on land values. There is no threshold, so you're paying on the total land value, and the rate is 5%, so a lot heftier than the rate for land tax. If you're a permanent resident and you've been in Australia for at least 200 days in the calendar year leading up to the taxing date, which is something that we haven't talked about yet. Land tax is calculated based on a taxing date. It's the 31st of December every year, right? So at midnight on the 31st of December every year, and everyone's saying Happy New Year, if you're a land taxpayer, you're probably going to be crying a little bit because the bill's coming, right? What you
Especially if
owe,
it's worth more than
I can
6.47
feel
million.
the governments around Australia also going Happy New Year as they're rubbing their hands together because they.
So yeah, at that point in time, the land that you own, that's what you're paying on for the following calendar year. But for surcharge, essentially at that key point in time, we're saying, well, for the 200 days of the 12 months leading up to that point, have you been in Australia? And are you a permanent resident? If the answer to that question is yes, then we consider you to be what we call ordinary resident, and you don't have to pay surcharge for the following year. What some people forget about, because there is also a surcharge purchaser duty, with stamp duty, transfer duty as well, right? So a lot of people will go, okay, well, the rules are a little different there. It's based on a contract date as opposed to a taxing date, but it's 200 days before the contract date, and they go, okay, I met it, fantastic, I don't have to pay surcharge. And then they go away, and then they forget that there's an annual surcharge for land tax.
Surprise.
Wow.
Now, can we talk to, so foreign persons 5% surcharge plus the land tax. So that's on top of whatever the land tax is. You were mentioning earlier about the different ways in which we can buy property, right? So like we can own it in our personal names, you and I, Bryce and I, individually, and we have that threshold. Couples have that threshold. When it comes to trusts and company structures, what's the difference around the threshold story?
Yeah, 100%. So look, we'll start with companies because it's a little bit easier. With companies, they do get a threshold. The difference being that if we can group the companies because of common shareholders or something along those lines, right? So let's say for argument's sake, I set up a company every single time I purchase a property and purchase under that company to get another threshold. Well, that's not going to work because we group companies together and we say, well, for the group of companies, you only get one threshold. So that's how that works. That's pretty straightforward. Trusts, that's where it starts to get a little bit trickier because there are a lot of different types of trusts. So you can have a trust that's considered fixed under the land tax legislation is quite restrictive. With those ones, we treat them as any other joint ownership. Then we trace the portion of land value that's applicable to each individual beneficiary back to them. But unless it meets those very specific criteria around being considered fixed, then we treat them as what we call special trusts. Now, there's nothing really special about them. It just means that there's elements of discretion in the trustee that allow the trustee to determine how they want to distribute income and capital, which is very common with family trust, right? And family trust is a structure that a lot of people will purchase under for two reasons, usually tax benefits at the federal level or asset protection is another reason. With the discretionary trust, you can't really trace the ownership back to any of the beneficiaries, right? because of that discretionary element that exists. So for those types of trusts, they don't get a threshold. So when I say they don't get a threshold, what I mean is the tax-free component up to that $1,075,000, they pay 1.6% from the first dollar of land value.
With your foreign owner surcharges, which we'll talk about later, there is a, for discretionary, you talk about exemptions if they've got a specific explicit exclusion of foreign beneficiaries. Does that apply here?
It does, yeah. So if you've got a discretionary trust, then by nature, the way that these trusts are established, like it's almost like anyone could be a beneficiary, right? So there's nothing stopping you from distributing income or capital to what would be considered a foreign person for land tax surcharge purposes. So essentially, yes, there is a requirement to exclude foreign beneficiaries from receiving any distributions from that trust if you want to avoid surcharge and have a property investment under a discretionary trust or family trust. But look, it's also important to keep in mind, like one thing that I've sort of seen over the years is people will go, well, maybe I shouldn't purchase under a discretionary trust or under a family trust because of land tax. But, it's just one consideration amongst the whole, sway of things that you need to think about when you're making that decision under what structure to purchase. And also there's this automatic sort of approach that people take. They go, I need to exclude foreign beneficiaries. It's like, but do you have an intention to distribute to foreign people? Because if you do, don't exclude them. It's going to depend on circumstances, your individual circumstances.
And can we round out, Vishal, the company structure? Like obviously trusts from effectively no threshold from $1, 1.6, and it builds up. What about with the company? You said there potentially is a threshold there. And are the percentages, the rates the same? Yeah.
So look, with companies, the rates are the same as what you'd experience as an individual. So, tax-free up until 1.075 billion, and then, the premium rate after once you hit that 6,450,000.
Yep. And so, and it's the grouping. To your point, it's obviously if those companies are then the shareholders, that's what you're trying to understand, those relationships, because you're then trying to then work out how an individual has reached or have they reached their certain threshold. Because at the end of the day, what you said earlier is really clear that they will aggregate all of those ownership exposures to eventually work out the individual's land tax payable based off those calculations.
And I think that breaks a myth too, Vish, because within the property investment community, back in the noughties, definitely in the 90s, but definitely in the noughties as well, there was like, oh, well, if I buy it in my own name and then my wife or spouse buys it in their name and then we buy it together, they're three separate entities. But what you're saying now is no, there's an aggregation across all of that to go, okay, well, we get that there's different matrices that you can have ownership in, but we're going to look under the bonnet and all that and then bring that all together under one threshold for you.
So, we don't go to the extent of saying, oh, okay, if you're a shareholder of a company, then that's going to show up under your personal name. So companies are sort of a bit separate, but where you've got an individual ownership interest, and that could be because you're a part owner, or it could be because you're a beneficiary of one of those fixed trusts that I was talking about. In those cases, we're going to bring it all together. And the whole purpose of that at its core is to make sure that you're only getting one threshold. So if you sort of, tinker away at it and see how the math all works out, that's essentially what it's doing. It's making sure that you don't receive any additional threshold to what you're actually entitled to.
Gotcha.
Now, Vish, in terms of, to Bryce's point, I'm pretty sure in other states and territories, trusts and companies have slight variations on that. And I'm also reasonably sure that the rates that are charged can also be different to rates that they charge individuals. Do you have much knowledge of sort of what's happening in other states and territories?
Yeah, so look, there's as I said, there's heaps to unpack with land tax when you start looking at across all jurisdictions, rates, thresholds, specific rules. A lot of people sort of try to find where the similarities are with land tax across borders, and there aren't a lot. It's not like payroll tax, where there's certain elements of harmonisation across borders. It's not like that with land tax. Very, very different across different states, and I think these days, it's becoming more and more popular for people to look at property investment across borders, and it's just something that you've got to be mindful of.
Very much so. I mean,
Yeah.
a practical tip here is absolutely get professional structuring advice and know what you're walking into. Vish has said at the start, so many people are surprised by a annual cost being land tax that they didn't know that they would have, and certainly a lot of Victorian investors have been incredibly frustrated by the threshold dropping to $50,000 in Victoria, originally from $350,000, if my memory serves me correctly. So that's why it really is important that if you are thinking about investing in property, you've got to plan for these types of costs to make sure that those investment returns are coming to you and not going to the government coffers. Bryce, I wanted to then move the conversation along with Vishal into exemptions and concessions.
Yeah, because here's the reason why I think a lot of people get surprised, Vish, because there's a very significant exemption, which is our principal place of residence, and so therefore people might have been homeowners for many years. Then all of a sudden they step into the property investment arena and realise that the rules are different. But principal place of residence is an exemption. We'll get you to talk to that. But you've said that includes dual occupancy, occupied land whilst constructing or renovating, incidental business use, transition between homes, deceased estates, temporary absence overseas. So there's a few things that you've gone to lengths to try and unpack, but this is the real culprit why land tax is a surprise, isn't it? Because it's of this major exemption.
That's right. Most homeowners don't have to pay it because it's their home, right? So if something is your principal place of residence, it's exempt. So it has no taxable value, doesn't contribute to the land tax calculation, essentially. And that exemption, yeah, you're right, at least in New South Wales, it has a lot of extensions to it to cover those scenarios where, say, for argument's sake, you've got a granny flat at the back that you're renting out, or, you're in a duplex, you're living on one side, renting out the other, it's all on one title. So you're allowed one other residential occupancy, and you can still maintain a full exemption for land tax. There are things around having an absence. So up to 6 years, you could be absent from your place of residence as long as you're not full-time renting it out while you're away. That there's a concession that can apply there. There's a lot of different concessions.
The dual occupancy one is quite interesting for me. And you mentioned a little clue in terms of one other resident. Are we saying, so if I build a duplex side by side in New South Wales and I rent out the other side, it could be still a 4-bedroom significant duplex on the one lot of dirt, am I getting, when you say one other, I might have a family of 4 or 5 people living in that property that's paying me rent. I'm still exempt from land tax in New South Wales?
Correct. So you'd still get a full exemption for land tax for that property, so long as you're also using and occupying it as your home, right? I mean, I'll take it a step further and say, even if you've got like a 4 or 5 bedroom house and a 1-bedroom granny flat in the backyard, it's all on the same piece of dirt, as you said, the same parcel of land. I could be living in a granny flat and I could rent out the big house, and that's still only one other residential occupancy. So I could still get the full exemption. But say, for argument's sake, I had 2 granny flats. If your council allowed it, let's just say if I had 2 granny flats, okay, then it's a different story. So then what can happen is, with the principal place of residence exemption, we'll give you an exempt. So we'll treat the part of the property that you're using as exempt, and the other part we'll treat as taxable. I think
just measured by area,
floor area, yeah, floor area for the most part. And I think one thing to keep in mind there is, we also have things like there's also, you're allowed to use a room in your home for incidental business use, right? But if you're running your business from home full time or using more than one room, then same thing applies. Would say, all right, well, part of your home is exempt and the other part could be taxable. But in New South Wales, at least, we're talking unimproved land value here, right? So for argument's sake, like my home, the value of my home versus its unimproved land value, big difference, okay? Even if I rented my home out, it would not go above a threshold. So if you're someone who's got and you can check your land value, it's really easy, check it online. But if you check your land value and it's below $1 million and you're like, oh, should I register for land tax? I'm using part of my property as a business, or, I'm renting out to more than one person. Realistically, the portion of land value that's going to be taxable is going to be still below the threshold. So it's not the end of the world. It's not something for everyone to always be thinking about. But when you're getting into those land values that are a little bit higher, then yes, then it's something to think about.
I think the general rule of thumb for people who are listening to this to remember is the greatest gift in the Australian taxation system is our principal place of residence exemption, capital gains tax, in this case, land tax. So the overarching principle for everyone is if you use it for shelter, then you're generally right. But as soon as you tinker with that, I'll try and earn some income over here. I might try and rent that bit out over there. I might run my business from. As soon as you deviate from it being the basic need, which is putting shelter over your head, you're dancing with the devil with all of these wonderful rules that are afforded you. And you've just given us a little insight there. Okay, all right. Well, if you dance with the devil, but you only have one extra dwelling, you're okay. But if you actually do two, then you're not okay. But I think
one title, it's got to so in other words, if you do the duplex and you turn that into a separate title, then that separate title is going to
taxable.
Yeah,
that's taxable.
Yeah.
Let's also quickly run through primary production land. So we've also got cultivation of crops, maintenance of animals, natural increase, and bodily produce. Is that right? Is that both
milk,
correct?
Yeah.
So they're also potentially exempt.
Yeah. So look, the next big exemption after your principal place of residence exemption is your primary production land exemption. So, anyone who's doing genuine farming, and look, that can extend to things like, people automatically go crops and livestock, but commercial fishing, keeping bees for honey, all that kind of stuff. It includes all of that. So yeah, that's the next biggest exemption type. The key there is that the dominant use of the property needs to be primary production. So
right. So in other words, if I've got a property that's a holiday home and I've got a water slide, tennis courts, basketball stadium, and then over in the water park corner I've got a box of bees that I'm making honey on, I'm probably not going to get land tax exemption on my holiday home.
That's right. That's 100% right. And look, I'll take it a step further again, and something that we've seen, and it's something for investors as well. Like, because not everyone's investing in residential housing. You've got investors out there who are looking at purchasing rural land that have farming activities happening on them. And as an investor who owns that kind of property, you should be kind of interested in what your tenant is doing, because they might be doing some farming, but if they're also doing, some of the stuff that we've seen, like they've got an Airbnb and 5 tiny houses scattered across their acreage, right? And we take a look at that and go, well, is the dominant production use?
Are they adding to the population growth?
That's right. Or is it agritourism, right? And that's where we start to draw the line and go, well, agritourism.
Revert to rule one.
Yeah.
Yes. Revert to rule
one. Are you messing with the its primary use as shelter or primary production? There's a bunch of other ones you've got here too. We don't have time to go into it too much, Vish, but mixed use, low cost accom, and boarding houses. Just out of interest, what is it? Quickly, what is an example of the low cost accom that would have that?
So look, they're very specific circumstances. These are exemptions that you need to apply for every year where you provide low cost accommodation. It's actually quite a lengthy piece of legislation, very specific, only applies to certain CBD areas and a 5 kilometre radius. So But
Gotcha.
essentially, there are exemptions and concessions that can apply there. But every year, there are rates that are gazetted. And as long as you're meeting those rates, you can apply for those kinds of exemptions.
To help with marginalised people. So you've got aged care, childcare, charities, sporting clubs, religious societies. So there's a few things there that qualify. What about transfer duty? You know, previously known as stamp duty. Tell us a bit about how that fits in your jurisdiction, and you know, what is it? What triggers it?
Yeah, so look, I mean, the transfer of property is what triggers it. It's in the name these days, transfer duty. So anytime you're transferring property, and now that can be a whole transfer or partial transfer, you know, doesn't only apply to the sale of land. And I think that's an important thing to keep in mind. So, you know, any transfer of property can be dutiable. There are exemptions and concessions that apply there too. Things like, if I pass away and my property is transferred to a beneficiary in accordance with my will, like those kinds of things can be exempt. But for the most part, like changing your ownership, and I think, you know, like going back to the land tax conversation, there's a few times I've seen people who have made a decision to purchase property under a particular structure, whether that be, you know, not just land tax related, but in the way that they want their investment, their taxes to be treated. And they go, oh man, I made a mistake here. I should have bought it under that structure. Well, you know, it might be a little bit too late or a little bit too expensive to change it now, because, you know, that too could incur transfer duty as well. So, yeah, it applies to all kinds of things. Any change in beneficial ownership as well. So even if you were to change a trust structure to say, all right, well, I'll change, you know, how the money is going to be distributed from this particular asset by changing the trust, even a change in beneficial ownership can be taxable. So, yeah.
That's why we say property investing is a process, not an event. There's a fair bit that needs to be thought about up the ground. But a couple of things that I find interesting, right? So I think a lot of people who are, you know, listening to this get stamp duty or transfer duty, but it's payable within 3 months of signing a contract, right? And then if you're buying, say, off the plan, you can defer that up to 12 months. But what happens if someone buys, they sign a contract and settlement's 4 months and it's due within 3, or they buy off the plan and settlement isn't for 2 years, but it's due in 12 months? Tell us some sort of case studies of how that works for people, and I'm sure that catches people by surprise.
Yeah, mate, look, I think you've pretty much nailed it. Yeah, that's exactly what happens. So at that 3 month mark, the tax is payable. So if you've got an extended settlement period, that's going to exceed 3 months. You know, usually they're about 6 weeks, but if you're going to go something that's longer than 3 months, expect to be parting with the stamp duty at that 3 month mark. Same with off the plan purchases. That 12-month extension that you can get off the plan is only if you're going to use the property as your principal place of residence. But you're right, like it could be 2 years. Like I spoke to someone recently, and they've been just over 2 years. They did an off the plan purchase. They had to part with their stamp duty after 3 months. So it's an expense that you need to think about. Generally, your conveyancer or your solicitor who's acting for you will notify you anyway, though. So hopefully it won't be too big of a surprise. But yeah, just in case they don't, because you know sometimes they don't tell you about land tax either. You know, it's really good to do your homework and know what you're going to be up for before you sign that dotted line and make that decision.
And Vish, I lived in New South Wales when Bob Carr introduced a vendor tax, which was highly unpopular in terms of selling properties. But let's get a few things right. So it's payable on purchase, gift, change of beneficial ownership, and obviously we were just talking about when it's due and payable. In terms of, for everyone's knowledge, investors and or personal use buyers, there's no change in the rates that they have to pay. Like, in other words, New South Wales has a set fee for both purchases.
So look, with the rates, they're essentially annually indexed. Okay, so there would have been a new set of rates published just on the 1st of July this year, and that happens every year, right? But for the most part, I mean, the amount of duty that you'll pay on a specific property is the way that the annual indexation works. It tries to keep it relatively consistent with what's happening, across CPI and other things. So, so the rates do change. I sort of tell people, hey, we have calculators on our website, so don't try to get too creative with working it out. Just hop on that calculator, punch in the purchase price of the property or the dutiable value. If you're not actually making a purchase and you've got a valuation instead, chuck that in and get the amount from there. That's the best way to do it.
Let's talk a little bit about some of our listeners might be wanting to help their kids, or we might have some first home buyers listening. So there's two bits of support that the New South Wales government does, and there's various schemes across the country. So people should obviously lean in on their own state or territory. But first home buyer support, you offer assistance around the transfer duty and a homeowner's grant. So let's talk about the duty first. You've got a couple of thresholds where there's a full exemption and a concessional exemption. Can you talk to us about that for the first home buyers?
Yeah, 100%. So at the moment, with the first home buyers assistance scheme, is the one that you're talking about. There's it's essentially it's an exemption from having to pay the transfer duty on the purchase of your first home. There are some eligibility criteria that apply to make sure that you are actually a first home buyer for the most part. But yeah, essentially up to $800,000, you can get a full exemption from transfer duty on the purchase of your first home. From $800,000,
both new and existing.
That's
new and
existing properties. Yep. Now, from $800,000 up to $1 million, that's where instead of getting a full exemption, you'll get a concession instead. So you get you'll still pay some transfer duty, but not the full rate. And people often ask me, they're like, so how much is the discount? And it's kind of hard to explain because it's a sliding scale. So I'll put it like this: the closer you are to 800,000, the
better.
The better. And the closer you are to $1 million. So if you're buying something for $999,000, don't expect to see too much of a discount on your transfer duty at that point.
Yeah, that's a good way to put it.
And then also for land value, Vish? Vacant land, sorry.
Yeah, so vacant land is 350,000. So different.
Good memory.
Different threshold that applies there, and the sliding scale thing works there as well, up to 450. So full exemption to 350,000, and partial discounted rate from 350 to 450.
And in the interest of time here, Vish, I'll go through your eligibility criteria because you've given it to us in advance, but it's the purchase must be for a new or existing home or vacant land. The transfer must be for the whole property. You must be an individual over 18. You or a spouse or partner must have never owned or co-owned a residential property in Australia. We'll come back to you, but we're assuming even if it's a previous investment property. You and your spouse or partner may have never previously received an exemption or concession under the scheme. At least one of the first home buyers must be an Australian citizen or a permanent resident, and you must meet the 12-month residence requirement. Can you lean in on two parts of that? One is if they had even just a percentage of an investment property in advance, and two, the 12-month residence requirement. What's the trigger? Is that moving in within 12 months of the settlement date or the contract of sale?
Cool. So let's start with the first question. So essentially with that, yes, if you have owned a property before, regardless of whether it's an investment or otherwise in Australia, you do not qualify, all right? And that requirement extends to your spouse, all right? So that essentially, if your spouse has ever owned property in Australia before, residential property, you're not going to qualify. There is something interesting there which I think people get confused about sometimes, because there is. So if you're buying 50%, let's say you're buying a property and mum and dad helping you out, for argument's sake, because we just sort of mentioned that before. So if mum and dad are helping you out, so long as you're purchasing at least 50%, you'll get the exemption or the concession on your portion. However, the non-eligible party will have to pay transfer duty on their portion, right?
Yeah.
right up until 95%. All right. So beyond, let's say, if you're buying 95% and you've got an equity partner coming on for 5% or less, we just treat that as fully exempt, right? However, if that equity partner is your spouse, as opposed to a parent or a friend or something like that, then see you later.
Yeah. Oh, that's a good little. That's a
good little bit of knowledge.
Yeah, 100%. Okay, so that's the transfer duty. So clearly where you are in the spectrum between 800 and a million will depend on what that looks like, and there's a few little tweaks just on the 12 months.
Yep.
What's of what?
Start date.
What's the line in the sand for the 12 months?
So the line in the sand is, so within 12 months of acquiring the property, so within the first 12 months of acquiring the property, you need to move in and you need to stay there for at least 12 months. Right? So
that's contract of sale or settlement of the property?
That's settlement of the property in this case.
Settlement. Okay, good. So in other words, if it's still being built and so forth, because obviously there can be situations where you've got a contract on a future build, we can't move in unless it's built. So that's on the settlement date. But there's two pieces there. Must move in within 12 months and must reside in that property for the full 12 months. It used to be a little bit shorter there, and some of these rules have changed. I know in Western Australia, if your spouse or partner had actually owned a property, you were still eligible for their first home owners grant back in the day. I'm not sure if that's 100% correct today as well. First home owners grant, can we just quickly summarise that?
Yeah, riff through it, Ben.
Yeah, so first home owners grant, $10,000 for new homes up to $600,000. Can be a house, townhouse, apartment, or unit or similar. That is newly built, purchased off the plan, or substantially renovated. I suppose there's a double click on substantially renovated for us, Vish. What does that mean?
Substantially renovated means, you didn't just go in and put some new floors in or, change the appliances. Okay, so substantial renovation would mean some kind of structural renovations. So that could be, stripping down walls, changing the layouts, something that would require the work to be done while the property is not occupied for the most part, right? And that's the key thing, because if it's works that you could do while the property is occupied, then it's, how new is it, right? Think of it like this.
So
it's never been lived in.
Newly built vacant land plus also cost to build. And so the vacant land, you can potentially get it on, and then the build cost can't exceed $750,000. Is that right?
That's right. So the combined cost of the land plus the build has to be $750,000 for that grant.
Why have you given an extra $150 between those two? Newly built and then you doing the work, and for it to become newly built, there's an extra $150 there.
I'm not actually sure, to be honest. So I didn't come up with the scheme personally.
We've got a housing crisis.
I didn't come up with the scheme personally, but
heavily lobbied by the land developers. Only joking, tongue in cheek. Vish is not going to say anything about that. Hey, it's been really good. We've uncovered a fair bit here, Vish. But one of the things that you sent to us in advance, and this is a question without notice, so I might be able to read some of this off for you. But there's, in terms of the first home buyers assistance dashboard, there's across New South Wales, there's in excess of 60,000 properties that have been affected. The value saved is over $1 billion, 1.2 billion, and the average value saved is 20,539. I'm pretty sure you guys are pretty happy to spread the word around that, right?
Yeah, 100%. I mean, look, it's good to see that these schemes are being used by the people that they're intended for. And I think, one of the bits of feedback that we often get is, particularly for Sydney-siders, what can I buy for under 800,000? It's like, if you're shopping with a budget of more than 800,000, then maybe this scheme's not necessarily designed for you. Like if you've got $1.5 million to spend on your first property, you're doing better than most people who this scheme's targeted at. But it does go to show that it is working and it does benefit a lot of people. So,
and it's got here, if you go to the Liverpool LGA, there's 1,100. If you go to the Campbelltown LGA, there's over 1,000. And then there's Parramatta, Westmead, Blacktown, Gosford, Mount Druitt. So clearly, the doesn't look like it's being done in the North Shore of Sydney, but there's the surrounds of the major metropolis of Sydney look like it's reasonably well covered.
Yep.
So I've got a couple of quick questions before now. All of the information in terms of tools and where to learn more, we'll put those in the show description. The New South Wales revenue calculators on the New South Wales website. You've obviously got the eligibility tools that you can check, and there's the dashboard and the first homeowners tracking information on there as well. My last couple, disputing a land value. Vish, is there a process? Can you just give us a quick summary in terms of if you're not happy with the land value allocated to you? What's the process?
Sure. So look, if you've got a issue with the land value, again, look, that's not a Revenue New South Wales thing, so we don't determine the value. So your objection would actually be to the Value General of New South Wales.
Yep.
Yep. You can go through that process. Essentially, it's they've got a tool on the website, and actually they just recently revised it, so it's made it a little bit more user friendly for people. But yeah, you can hop onto their website, or you can even Google it, land value objections New South Wales. It'll take you straight to the right page to proceed with that process. But yes, you can object to a land value.
Beautiful. And my final question would be remiss property. Commercial property is a bit of a flavour of the month for some at the moment. So in certain jurisdictions around the country, if a land tax bill is payable, is it the same ratios for commercial? And my second part B of that question, can they pass that land tax bill on to their tenants?
All right. So in New South Wales, there is no different rate that applies for different zoning for properties. So whether it's residential, commercial,
or commercial,
the rate is the same. In terms of passing the cost on to your tenant, I mean, look, that comes down to what the owner's doing and what the rates are. Like in some places, particularly for commercial property at the moment, like it's people are competing to get tenants in. So, at the end of the day, that comes down to the landowner to decide how much they're going to pass on and how they're going to remain competitive in that rental market. But there is, there's nothing that's saying yes or no, you can't pass it on.
Whereas in other jurisdictions, there are.
Yeah.
So that's why, again, it's a really nice way to finish off my two bobs worth in terms of commentary here around you absolutely want to check that in terms of whether there are any rules and regulations around retail commercial leases and the different types of business-to-business type leases, because in some states and territories, it's banned to pass on land tax to the tenants. So always good to do your research.
I think in New South Wales, though, one thing that I will call out there is that it is still the landowner that's going to be held responsible for paying the land tax liability. So we're not going to go chase the tenant for it. If the landowner doesn't pay, it's still the landowner's responsibility to pay.
Yeah.
Mate,
well said.
Bringing back some of your collections,
my collection days, yes,
department days, which is good. So, hey Vish, thanks for really coming on and helping clarify. As we said at the top of the show, it's been specific for your role into the New South Wales jurisdiction, but look, there was a few sort of specific thresholds and taxes and stuff, but in most part. It was a real exercise in reminding people land taxes here, surprise, and
not going away,
and don't be surprised by it. And by being proactive and asking the right questions and making sure you don't get into double dutiable scenarios. And some of the property investors love to scheme and find ways that they can get around what's due and payable. It's kind of like, well. If you're using it for a roof over your head, you're usually pretty good. If you're actually mixing the use, beware. Make sure you're informed and make sure you do the work up the ground to make that known before you get a nasty bill that you weren't planning for. But mate, it's been excellent. Thanks for sharing your wisdom. Clearly, you've got a lot of experience. And on behalf of everyone here on the Property Couch and all of our community, thanks for coming on the show.
Thanks for having me, guys.
Thanks, Vishal. Thanks very much.
Pleasure. All right, mate. So It's funny, that the time went really quick in that conversation, and it's not the most sexy conversation going around, but there was some incredible little nuggets of wisdom that were dropped in there that, irrespective of which jurisdiction you live in this country, they should be little nuggets that prompt you to ask the right questions and ideally plan and prepare for land tax.
Yeah, I couldn't agree more. I mean, I learned a lot about, well, there's a couple of little clues in there about sort of first homeowners concessions that I also picked up on in basically if it's not your partner or spouse, your parents can also still take an interest in the property, and you get a little, in New South Wales, you get a little kick in terms I'm liking that.
Yeah.
That makes a lot of sense to me. Of course, the message we have is every state and territory does have their own nuance. So understanding those nuances are going to be important about how you set yourself up. And we've been pretty simple, Bryce, haven't we, over the journey? We've always said buying properties in your individual name keeps things really clean as you start out. And then potentially if you want to get a little bit more sophisticated, potentially you can do that through exploring entities and also exploring other assets such as commercial and so forth. But as we say in the book, $3,000 a week, it only needs 2 or 3 good properties, maybe 4 in some cases, for some people to supplement that income. So I took a lot out of that, Bryce. I also, just a little side note here, mate, back in the day when Howard and Costello actually introduced the GST on the 1st of July 2000, part of the negotiations with the state and territories was to abolish a few of these state-based taxes. And so here's what they agreed to. Bed taxes, financial institution duty, FID duties, stamp duty on marketable securities, debit taxes, stamp duties on unlisted marketable securities, mortgages, leases, hiring agreements, checks, bills and exchange, and promissory notes. But what they didn't agree to, even though they tried to get it over the line, was stamp duty on property transfers and that other evil tax, which is payroll tax. So they are the two that didn't make it on the list, even though I tell you what, if we're going to negotiate putting the GST up, which we should be doing for the record, it absolutely needs to go up. Maybe part of those negotiations should be removing these very, very ordinary taxes, right? They're unproductive taxes. They are horrible in terms of basically how we operate this country from a productivity point of view. So I would love to get those types of taxes removed. Inefficient taxes, we call them.
Yeah, I think I agree with you, Ben. At face value, or increase the GST means we pay more, but it's a consumption tax. Those with more money are going to pay more than those who don't. So it kind of
progressive taxes is uninspiring, Bryce.
Yeah.
GST is a consumption tax, and so if you've done well, you'll spend more and you'll pay more tax. But what you don't want to do is diminish aspiration in this country. Why would I work more if you're going to take more? Just remember, Bryce, I go to work now and I say, okay, the first 2 days of this week I worked for the government in paying taxes, right? And then the next 3 days are mine because obviously I pay a higher tax.
Yeah.
If more people understood, most people go to work for 1 day a week for the government. And I don't think that that's aspirational at all.
No. Well said. Hey, my Life by Design hack today is success leaves clues. Show me your fridge and I'll show you your health. Show me your books and I'll show you your goals. Show me your calendar and I'll show you your priorities. And show me your friends and I'll show you your future. So,
nice one. I like that.
Your lifestyle by design starts with the choices you make right now. It's not when you get 3,000 a week, Ben. It's the choices that you make now. So have a think about that. What's in your fridge? What books are you reading? What's in your calendar? And which of your friends are you associating with? Because they'll tell us a lot about your health, your goals, your priorities, and your future. Life hack for you to ponder this week, folks. Hey, Ben, what's making property news?
Well, mate, at the start of the teaser at the start of the show, I promised to talk about where you can potentially find a $500,000 property in our major capital cities.
Is that possible?
I am about to share that information to you right now. So I'm just getting my screen loaded. Hopefully that's come up for everyone to see. And we can see here that what I've got is Brisbane, Melbourne, Perth, Adelaide, Hobart, Darwin, Canberra, and Sydney. And I want to show you, first of all, let's look at both of them together, and you can see just
Houses
effectively.
and units, you mean?
Sorry, units and houses. What did I say?
You said both of them together.
Oh, both. Sorry, yeah, units and houses. That's right for people. But have a look at, so you can start to see a little cluster there. Now, obviously, the scale is so far because of these big outliers that are some of these properties in Sydney. So let me remove Sydney from the list, and you can start to have a look at both there, and you can see that, yes, in terms of being able to find property in most states and territories, there is a little opportunity in there in terms of what that looks like. And what I'm going to do now in terms of, let me just quickly show you units, and we'll just have a quick look at Sydney in terms of what that looks like. So sort of people to see, there's the Sydney number. Yes, there are still markets in Sydney where you can buy apartments for under $500,000. So
hover over one, Ben. Hover over one.
I'll hover. Okay, I'll show you. I'll just put camera on the map as well. So let's hover over the cheapest one. So in is it Carramar units? It's got a very high DSR score at the moment as well. 365,200 is the typical value, and so typical value we use is basically a read of the last 3 months rather than a 12-month medium, which is our own proprietary data here at Empower Wealth. Okay, so let's now unpack this a little bit more because it gets quite interesting. I'll take Sydney out, but let's bring back all the other capitals to see what we can learn as they start to unpack themselves. Now, you can start to see here that it's quite hard to find a location anywhere in Australia for a house under 500,000. Now, we've got a couple in terms of Herdsman's Cove in Hobart. So there are a couple of little spots there in Hobart. We take Hobart out, and you can almost draw a line in terms of there's a couple of little spots here in terms of around the Melbourne, sort of what we would say fringes of Melbourne as part of that particular story. So it's pretty clear that it's very difficult to now buy houses around our capital cities. And so that's why the commutable and the regional commutables into our major cities are becoming quite interesting, not only for owner-occupier from affordability point of view, but also for the investor market in that space as well. So there you go, Bryce. Obviously, lots of other rich data that we have the luxury of looking at, but I thought I'd just unpack that little story for everyone to have a look at.
I like it, Ben. It's good to know that the line in the sand has been drawn, Ben. The capital city action at 500,000 or below is well and truly something that we look up in the archives of history more than what it is today. So very good. Well done. Thanks for sticking around, folks, to learn about that. But, mate, it's been a good show. Again, we thank you to Vish from Revenue New South Wales for coming and sharing his insights and his wisdom and all of the stuff that he's involved in intimately on a day-to-day basis there, but equally applies at a broader level across the country, albeit with some specific nuances in your jurisdiction, mate. So until next week, Ben.
Knowledge is empowering, but only if you act on it, Bryce.
Well said, Ben. See you next week, folks.